crisis. I'm sure you are all thinking, well, just can't avoid it, right? You turn on the news, there it is. I confess, I asked my husband, can you please switch the channel because I can't listen to it anymore. And the reason is that, not that it's not an important topic, of course it is, but I'm not sure that the causes of the crisis are always interpreted correctly. And if we are not getting the causes of the crisis right, then we are less likely to be making the right policy recommendations how to avoid a future crisis. So, in terms of an outline of this, an outline of the presentation, but in general I'm going to be very quick because I'm targeting the 10-minute limit. So a very brief background on currency unions, the general origins of the euro crisis as I see it, some specifics about Greece, and I would like to touch upon some bad ideas for the future of the euro, some policy recommendations that have been floating around, and make some alternative policy recommendations, and draw some implications for financial sector management as well. So when we talk about the Eurozone, obviously it's a currency union, and the main theory that most people refer to is the optimum currency area theory of Mandel and McKinnon from 1963. Obviously, it's a pretty old theory, so many things have changed since then. They looked at factors such as trade links, labor mobility, monetary policy credibility, and are the regions synchronized in terms of the shocks that are hitting them. But since then, some other alternative issues that have come about that have not been included in the theory of optimum currency areas. So for example, the criticism by Rose and Frankel that the optimum currency areas looked at whether the countries, for example, are synchronized ex ante before joining a currency union, not after joining the currency union. And Rose and Frankel hypothesized that if countries are exposed to the same monetary policy, they will start eventually exhibiting a greater correlation in their business cycles. Also, another issue is that obviously the world has changed since the 60s and 70s, and we've had this huge explosion in capital mobility internationally in the 1990s. So capital is flowing globally, very freely, and in large volumes. So that makes it impossible to maintain the old international currency systems of pegs, which we call soft pegs these days. And another issue that comes to mind is the fiscal dominance of monetary policy. We have the Stability and Growth Act included in the framework for the functioning of the European Monetary Union, which sets target for budget deficits to be less than 3% of GDP and public debt levels less than 60% of GDP. IMF also imposes such conditionality on borrower countries, and the reason is that you cannot have independent, credible monetary policy when you are in fiscal distress, because governments have an incentive to inflate away the nominal burden of that debt if it is denominated in local currency. So that was actually one of the big motivations for creating the European Monetary Union. Many Western European countries in the 1980s and 1990s have had large budget deficits and high inflation. They tried to pack to the Deutschmark to enhance their credibility and kind of import the conservative monetary policy of the Bundesbank. Now, there's also a great deal of literature on the other benefits of the euro. Obviously, less exchange rate risk, increase in trade volume, depending on studies, putting it at 5 to 15% increase. Also, is there opportunity cost to giving up monetary policy? Well, some studies again suggest that there is no benefit, actually, from having an independent currency or a floating regime. The countries are affected by global shocks just as much. There is also studies on improved competitiveness. Since the introduction of the euro, We have the low inflation mandate of the ECB, and very importantly, lower borrowing and transaction costs for governments, corporations, and households. So all of this should lead to financial deepening and better risk sharing. As this happened, well, we have greater financial integration, so that creates the scope for better risk sharing, but it also means that we are more financially linked and dependent on each other, so we are also likely to experience crises that have their origins in other countries. So overall, it depends on institutional development. How well are the markets functioning, and so on. So the general origins of the euro crisis, as I see it, well, we really have to look at the fiscal situation. There are studies that prove that public consumption in the Eurozone countries has been typically pro-cyclical. So that means governments have not been running surpluses in times of economic growth to balance out the deficits from recessions. So the Stability and Growth Pact fiscal criteria have not been respected by most countries. And at the same time, we have these ballooning public debt levels, not just in the Eurozone crisis, but also in UK, which is not part of the Eurozone. We have the same situation in US and in Japan, where public debt is at the highest level, around 200% of GDP. So why are these countries experiencing similar problems? Why are they not penalized in the same manner as some of the Eurozone countries are? And why are we calling this really a crisis of the euro, when ultimately I think it's a fiscal crisis? So how did we not see this coming, right? Well, there's evidence that credit ratings and sovereign bond yield spreads did not reflect the fiscal situation in the Eurozone countries. So if you see just 3 studies right there, there are probably more that you can find that show that there was not discrimination in this kind of signaling in financial markets and pricing in the risk of bad fiscal performance. Now, the case of Greece specifically, they joined the EMU in 2001. They had good growth rates in the 2000s up to 2008, 3 to 4% of GDP. That's very, 3 to 4% real growth of the GDP. It's pretty good, better than many other countries in the Eurozone. Current account deficit also actually improved for some time, but government debt to GDP was around 100% even upon entry. If we look at government revenue, 40% of GDP, government expenditure systematically higher at 45 to 50% of GDP. So that should have raised red flags clearly. While there is some evidence that actually Greece concealed some of the bad news in terms of the fiscal data, overall the magnitude, I think, of those concealed budget deficits doesn't warrant to say that we could not have seen this coming. So why were the fiscal warning signs ignored by creditors? Why were they not priced in? Why did credit agencies did not downgrade earlier? And in general, why are fiscal consolidations delayed by politicians? So, well, politicians might be aware that they have bad aggregate fiscal numbers and they might even want to do something about it. But the question is, who will bear the cost of the consolidation? It's not going to be evenly distributed. And then we have right there the conflicts of interest between different parties and their constituencies. So another issue is that most politicians, remember, have limited horizons. Well, maybe the fiscal situation is bad and it's going to be worse 5 years from now, but maybe I won't be in an office, so I don't necessarily care. And in fact, if we look at that old experience since the 1990s, when OECD countries also had high levels of budget deficit and debt, Canada stands out because Canada was able to bring down those debt levels most successfully. And why? Well, if you look back at the political situation, we had the Liberal Party in power, and at that time, it was pretty certain that they will continue to stay in office for a longer period of time. So they had more incentives to internalize the government's intertemporal budget constraint looking 10, 15 years ahead. Now we have more political uncertainty, so unless we have an ideologically conservative government, we could be seeing increases in fiscal spending, for example. Now, and if you look at the case of Greece specifically, there are a number of studies, for example, this one by Mitsopoulos and Pelagidis that says it is labor market and tax distortions ultimately that got Greece into fiscal troubles. So we have highly progressive income taxation, but it's not really effective because basically half the households in Greece do not qualify for paying income taxes. So there is also a very high share of self-employed, which can lead to underreporting of income. So again, measures that would raise the progressivity of the tax or impose higher taxation on wealthier individuals, of course, are more politically popular, but they are less likely to be effective in terms of raising government revenue. And that also explains why we have the popular revolt against those consolidation measures that would actually impose income taxation on lower income households where the minimum wage is very close to the median wage. Actually, we have that peculiar situation. So overall, I see the origins of the crisis as a lack of fiscal discipline, having nothing to do with the euro. It would be there even if there wasn't any euro. What we would see would be the usual currency crisis with capital flight, expectations of inflation, a steep currency depreciation. Right. So some bad ideas for the future of the euro as I see it that have been floating around. For example, number one worst idea I would say is to make the ECB more politically accountable, meaning create multiple objectives for the ECB besides having the low inflation mandate to include promoting growth and employment, for example, giving the European Parliament or even the group of finance ministers in the Eurozone the ability to fire the ECB president or other members of the board. Obviously, that would create a great deal of inflationary expectations, which would be very costly because those would be built into expectations of depreciation, inflation, wage and other contracts, etc. So we would not have the benefit of low borrowing costs, for example, and inflation in general. It's a regressive thing because it tends to hurt the poorer populations more than the richer ones. Now, penalties for not meeting fiscal targets, or sorry, some members leaving the EMU, again, not going to be helpful for the same reasons. Penalties for not meeting fiscal targets, these are proposed to be at 0.1% of GDP, which is very small compared to the overall level of deficits and debt, so it's unlikely to be a deterrent for governments to continue delaying fiscal consolidations if their backlash politically at home from cutting spending or raising taxes is much more significant. And if we were to impose higher penalties, then it would be counterproductive because we would be just deteriorating the fiscal situation of the affected countries more. Now, another issue is the more fiscal centralization. I don't think having a centralized EU budget would help. What would prevent politicians at the EU level from overspending? You could argue that they would be even more removed from the electorate, less accountable. There is no reason to believe that they would behave in any different way. And there is that specific new proposal for the common consolidated corporate tax base with apportionment formula to member states. We can talk about it more during the panel discussion as well, because I think it's important. I'm not against having standardized accounting standards, or maybe not even being able to write off some losses in one country against profits in another country, but my main problem with this proposal is the apportionment formula to member states, because it assigns more revenue to countries that have more of the assets of companies and employment, but essentially it might be benefiting the countries that have higher costs in terms of, for example, employment, as opposed to the most efficient ones, most competitive ones. So again, it would be redistributing revenue, I believe, from the Central and Eastern European countries, or in general countries with lower labor costs, to the richer countries. Now, some alternative policy recommendations. Well, I think the number one problem that we have is that politicians have limited horizons. So if the penalty for bad behavior comes later, when they may not be in office, they are unlikely to comply. So how can we bring about measures that will penalize politicians as soon as possible? So that might be difficult. I think financial markets will have a big role to play in that regard, but also some other recommendations in general enhance the transparency of public finances to create more scope for accountability, greater fiscal decentralization rather than centralization, I would argue. There's also some evidence that spending decentralization is linked to better fiscal performance of the general government. And the easiest way, of course, to deal with the problem would be to focus on growth. Reduce the debt to GDP ratio, it would be the least painful option. So focusing on policies that get rid of those distortions in labor markets or in tax systems would be beneficial. Now, implications for financial sector management. Again, I don't have the solutions here, and I'm hoping we can discuss this in greater detail. But I would like to hear your opinions on, for example, how can we make rating agencies do their job? Because a lot depends on those ratings. They trigger certain portfolio allocations, but it's not easy to say how they should be regulated, because governments can have bad influence on rating agencies as well. They have a conflict of interest in that regard. Then another suggestion would be to evaluate portfolio managers on long-term performance measures, not just for short to medium term. And of course, if you are an analyst of public policy, I would strongly urge you to include contingent liabilities in public sector risk assessment. That means not just things that are on the book, but anything that can go wrong in the economy, and then governments feel compelled to intervene and increase their spending on that issue. Thank you very much.
But essentially, to the right of Alena, we have Stilin Petrov. He is the Director of Structural Risk at Scotiabank. His past roles include Senior Manager of Structural Risk with that team, as well as Manager of the Treasury Risk Management Group of Maple Leaf, and Treasury Analyst and Balance Sheet Management within that group, at TD Bank Financial Group. He started off as a trader at Societe Generale, and he was a Master of it was economically discussed in the vehicle, if I remember, from Belgrade, or was it Bulgaria? My apologies. And to the right of him is Rob Whitman. He is President and Chief Executive Officer of Jameson Bank. So obviously he is a senior executive in charge of leading and managing global teams of trading and sales professionals involved in the world's largest and most efficient markets. He has over 25 years of direct experience and participation in the foreign exchange and interbank trading and sales, which he accrues about 10 of them was with BMO, as well as Managing Director at RBC Capital Markets. To the right of him, we have Alex Jershevsky. Hope I pronounced that right. All right, Managing Partner at Recovery Partners, a 25-year veteran of the global financial markets. Essentially, he is into the restructuring right now, divestitures type of business, and he founded that in 2001. So very hot topic, obviously, based on what we're discussing today. He also has worked, he speaks, oh my gosh, English, French, German. He's almost like a global trotter. He's worked in the UK, Japan, Canada, and Australasia. So prior to his current undertaking, he's held economist, monetary, financial analysis roles at BMO, and as well as CIBC with Dundee in Tokyo. So great having you fellas, and I'll leave it to Bernie Wolf to moderate.
Thank you. Well, we're off to a really good start. I think you've given us a lot of background. Not that what you said is without controversy. And so let's begin with the panel, and we'll go in this direction. And maybe we'll stop here too, and then we'll come back to you. And I think that this is a little different than what I had planned, but I think it worked better. The question that I want to raise first is, where do we go from here? Where do you see the Eurozone going? You know, crystal balls are obviously very cloudy, but you know, what do you think is likely to happen? Is there going to be another bailout? We're going to just muddle our way through. You know, what is likely the likely scenario? What are the probabilities associated with that? So, you know, where do we go from here? If you had to, you know, make a good guess.
Oh, probabilities. Probability of the Eurozone being altered is less than 1%. Let's start with the controversial statements. I think I agree with the presentation. The root cause is not the euro by itself. It's actually the benefits of that have been documented. Certainly, to add to the presentation, yes, it lowered cost. It raised the asset prices in all these countries because of that lower cost that you're discounting cash flows and everything. So, like, you know, it had multiple effects around the economies of that region. I mean, you don't have to look backwards historically. I mean, look at Greece and Italy. They didn't have exactly a very smooth 50 years before joining the Eurozone anyway. So, like, these are legacy issues from before that. They have nothing to do with the euro currency. The benefits of the euro currencies are there, documented. And the how do we deal with that is really an interesting question. But I think the wrong focus here is on the future of the euro by itself. It's not the future of the euro, it's the future of these countries who are not able to manage their fiscal positions. And they have a history of that. And it's pervasive, right? So outside of Germany, I don't think there is one country that's not in doubt. Even like Dutch finances right now look a little bit interesting as well. Netherlands was considered one of the core countries until December, January. All of a sudden now they're not a core country anymore. So it's really funny. It's not impossible to predict, but the chances of the Eurozone breaking up are very, very small. There are a couple of fundamental dimensions to that. The first one is political. The second one is the social one. The third one is probably the financial one. Politically, it would be a suicide to any government to dismantle the euro. Rhetorics aside, even Germany is now kind of supporting a bailout, firewall, whatever you want to call it. Like the 1 trillion thing was called today, I think, by someone metaphysical. It could solve a lot of other problems in the world, but the reality is the money is going to be there, one way or another, to backstop that. Socially, it's going to be hard. It would really be a function of what these countries are willing to implement against social unrest and stuff like that. The spillover effect might be really what we're worried about here. And again, like, you know, but going back to the political situation, what makes things even more interesting is if in France now we have a socialist government, or president for that reason. It's really going to be interesting to see the dynamics between Germany and France in a different relationship. Even the Sarkozy-Merkel relationship wasn't very smooth at the beginning, and they're on the same side of the fence. It's going to be really more interesting with a populist type of a spending government in France. So the political risk is there, the social risk is there, the financial risk is probably the lowest of them all at this point, at least for now. So they bought some time. And it's really important to see continuation of fiscal measures being implemented. And it's going to be hard. There are elections in Italy, elections in Greece coming. There's a lot of refinancing in the Eurozone from core, non-core debt markets. There's trillions of debt that need to be renewed this year. from a liquidity perspective, and it's going to be an impact on the euro as well. Having said that, likely there will be a very strong fundamental reason to keep the euro, given the benefits are there. That whole thing about the building without exits that they have built was probably designed for a reason. If anything, contrary to what probably was suggested in the presentation, there's going to be more of a impetus to have a fiscal integration of some sort implemented. Whether that's the right thing or wrong thing, we're not going to argue about that, but that push is probably going to continue. Worst case scenario for the countries that are delinquent would be some sort of a fiscal board, similar to what, say, Bulgaria has with the currency. Like, I would never thought that I would be in a situation to say Bulgaria has a fiscal policy that's better than Greece, but here we are. Things can change over 10 years. I mean, Bulgaria is a country that defaulted like 2 or 3 times in the 90s, right? So there's hope. But yeah, I mean, it's like, I don't exclude the fiscal board for these countries being implemented of some sort, being as a centralized fiscal planning, whatever mechanism they come up with, or some sort of a political, diplomatic initiative that forces them to adhere to the agreements. Because like literally at this point, there is no control over these agreements being implemented in full. And that creates a moral hazard because the governments are facing elections both in Italy and Greece within a year, and it's really hard to implement changes that are going to jeopardize that. So fundamentally the political situation is actually the muddiest, I think, where if the populations revolt and reject these reformist governments and put back, say, Berlusconi in Italy and whatever in Greece, you end up with a situation where these political measures are not going to get implemented. So that's the biggest risk. So I think what they need to navigate now is continuity and stability on the political front in these countries and enforcing the fiscal discipline regardless of who's in power.
Well, I'm neither an academic or an economist, so I'm just a knuckle-dragging trader. My comments are fairly short and to the point. Your comment around a building with no exits means when the fire starts, everybody burns, in my opinion. And I very much do agree that the issue transcends politics. It becomes one of a social nature. And when it comes down to the Eurozone in particular, you do have to realize, as has been pointed out, that I think a modicum of fiscal consolidation is absolutely required in order to make this work. But in my mind, as I've made a note walking in tonight, that to me is simply code word for loss of political independence, or for all intents and purposes, the Germans controlling Greek budgets and collecting their taxes on their behalf. And I don't think on a social basis that's tenable. It will become increasingly obvious as the fiscal reality unwinds, impacts the political landscape, and ultimately bleeds through to the average Joe on the street. You've seen a little bit of that in Greece. You'll see more of that in Portugal and Spain. And I think the social disruption will ultimately be the root cause of how this all unfolds down the piece. Somebody said not too long ago that the euro is not an economic currency, but a political currency. And I think that rings very true with me in principle and on a textbook basis. It makes eminent sense, but in reality, when you ask the Germans and the French and the Italians to work together after centuries of alternately being at each other's throat and plotting against each other, I think moving through to the economic stage, things really move from a physical battlefield to an economic one, and as such, to me, it becomes increasingly obvious that you have sort of the Northern Euro, where you have the Germanic discipline as it pertains to how they would like to see things run against the social and political dissonance that the Southern European countries, whether it's Spain, Portugal, Greece, or others, approach politics, government, and fiscal jurisprudence. To me, it will all ultimately end in tears. I'm just surprised that rating agencies notwithstanding, they tend to, in my experience as a trader, be a lagging indicator of what's actually going on. This is all a layup for the guy who's going to speak for the next 15 minutes, because I've heard Alex speak, and I'm all about introducing, I think, from what I understand, is his point of view. But having said that, the question I would ask as a historical market practitioner was, how come it hasn't come to where it's at now much sooner? Like, how could we collectively as a market have not priced risk in as an efficient manner as the markets would normally have indicated? So I'm actually throwing out a question.
Short answer, greed and corruption. You missed a very salient aspect of my background as relates to the issues we're discussing here. I used to be the public debt manager in New Zealand when we did the big restructuring and got the country upgraded in the early 90s. I was also alternate governor of the IMF, so I've got a little bit of knowledge of what's going on there in Europe. My view on this whole situation, you asked about probabilities, is the fact that nothing's been solved here, guys. There's been no solution applied. Going back to first principles, how do I know? There's nobody in charge. I'm in the restructuring business. When you got a problem, when you find somebody with his head bleeding on the floor, you send somebody in to deal with it who's got authority, who can actually manage the process of getting that person back to health. There's nobody in charge in Europe, okay? There's been no solution applied. And what that's done, what they've done so far has constrained their future ability to act with policy. Fiscal, monetary, completely constrained. Industrial policy has been constrained through what they've done so far in trying to fix this problem. What they've unconstrained is the possible set of outcomes. So what we're exposed to now in the world, with Europe accounting for a quarter of global GDP, is a new set of black swans that we don't quite understand, but the probability of those black swans emerging out of nowhere is very, very high because of what they've created. The LTRO has basically made the weakest banks now the guarantor of systemic risk in Europe. That's what they've done. They've addressed some liquidity issues. They haven't addressed the problem in the interbank market, and they haven't addressed asset quality at all the banks in Europe. The banks are zombies. They're bankrupt. It hasn't been addressed. It's been kicked down the road. That's a problem. The other thing is, it was alluded to that there's a low probability of the Eurozone breaking up. It's actually, according to market estimates, the IMDb futures are estimating that there's a 50% probability that one country will leave the Eurozone within the next 2 years. These are traded instruments that gauge market sentiment as to how likely one of these events are. People can bet on a lot of stuff these days. This is an exchange-traded instrument. 50% is the probability. I put on my statistician's hat, my econometrician's hat, and I say, if I got a 50% probability of something, that's as good as saying it's going to happen. So we're in a very risky period right now. The other thing I would say is, from a historical standpoint, if you go back through all the restructurings that happened in the post-war period, all the fiscal restructurings, consolidations that were attempted, you come up with a number of about 145 since in the post-war period. There have only been 2 success stories. One is, and where you define success as a consolidation of debt to GDP of 10% or more. So my debt to GDP ratio starts at maybe 70 or 80, and it goes down to 60 or 70. 2 success stories. One is New Zealand, where I was there. I did it. I know what it took. And the other, after we did it in New Zealand, and we met Bill Birch a couple of times at the IMF, and he asked what we were up to, and why we were getting such good press, and why our credit rating was going up while Canada's was going down. They started it here in Canada, and they were able to push it through. Those 2 restructurings occurred in a market, in a world market, where these are 2 small economies with freely floating exchange rates, and a key linchpin of their ability, of both Canada and New Zealand's ability to fiscally consolidate, was the fact that they depreciated the currencies, revved up the export engine, got the currency, got the net export flows flowing in, investor sentiment changed, and you had your fiscal consolidation. The more typical situation is that these things are attempted and abandoned because they're very difficult to sustain politically. You have to have a political consensus that cuts across the electoral cycle and lasts 5 to 10 years, because that's how long it takes to turn these boats around. It's like, you're driving a country where your indicators are flashing red and you want to get them to yellow to green. It takes a long time to turn the situation around, you have to maintain consensus. In New Zealand, there was a high degree of consensus because the country had gone through an 8-year recession. So by the time I got there, it was ripe. I had a carte blanche to do what I needed to do in terms of retooling the finances of that country to make them improve over a period of time. But it's typically very difficult to get this done, and that's why there have been 145 failure stories. So to listen to people tell me that this austerity program is going to work in Europe, they're swimming against the tide, folks. That's a very low probability bet. And that's what the IMDb futures are telling us. You've got 43% youth unemployment in Spain, in Portugal. In Greece, you've got a million people on the move out of cities into the country. Where are they going to live? In tents. How are they going to heat themselves? By chopping down trees.
We've seen, some views which suggest there's light at the end of the tunnel, and then there's others where it looks awfully dark, and only a slight glimmer if you do what you need to do. I don't want to add to the pessimism, but I just want to say that I want to basically hit on the social. I mean, you're just asking for trouble with the kinds of unemployment rates that you have in some of these countries, particularly among young people. Those people are going to be disillusioned. They're going to be disillusioned for life. That is going to lead to political instability. Maybe not, I don't know about looting or what, but who knows what kind of governments we're going to get, and people who really, feel that, they've been robbed, and that is extremely dangerous. And also, given that you have the haves and the have-nots, the Germans and the Greeks, if you want to put it that way, you are going to get a rise of nationalism there, and that is also dangerous. And the European Union was, in fact, designed originally to avoid this.
Yeah.
I mean, the idea of the European Union was not so much economic, it was political, it was so that you wouldn't have shooting across the Rhine, or in whatever direction.
It's now an economic battlefield.
Yeah. So you really have now put the seeds in place for a lot of destruction. And I agree with Sajana that we need to focus not just on austerity, but growth. Because that's the only way you're going to get yourself out of this. And if you push too hard, and the Germans, do have a point, and they benefited highly from, selling to the Greeks and such, and they forget that. Now that they have to, bail them out, they're not so happy about it. But they don't remember that, unfortunately, even though they have, super memory when it comes to, inflation of the 20s, they have a super memory there of not wanting to, have rampant inflation. What they seem to forget is the way, the French and the British tried to squeeze them after the First World War in terms of reparations and what that caused. And I think you end up with a similar scenario in Greece if you push the Greeks too hard. They made mistakes. And here's where I disagree with you. I think the euro, in fact, was important here because they never could have borrowed so much if they weren't dealing. They were dealing with drachma. They couldn't have borrowed nearly as much as they were able to borrow. The whole financial system fell down in not assessing risk properly. And that's not the first time.
Well, you had a bias toward accumulating sovereign risk in the Basel rules themselves because there's zero risk weighting. So you didn't have to put up capital. A Greek bond was equivalent to a bond.
Right. And the interest differential just collapsed. And before it was much higher, and when it was higher, you would less likely. And if you did make a mess, then you could bail yourself out by devaluation, which, then that could be messy because it may not work, but at least it is a way out. Right now, you have a box. You have that building without exits for Greece. And, when you put an animal in a cage, and I don't mean to really make an analogy with Greece and an animal, but, the animal really becomes very aggressive because the animal really doesn't know what to do, is really scared. And you can have that kind of situation. And the Germans seem to have forgotten that if you press too hard, you are going to get very negative results. So I think there has to be some balance here. And I agree that, you know, the weak sisters have to, you know, be restructured, I guess is the word, because if you don't, you have problems. And if you prolong, you know, all they've done right now, I agree, is bought time. But, you know, time that you buy actually becomes more expensive as you buy more of it. And you start to get into a more dangerous situation. Now, I'm not convinced that everything can turn out okay, but right now, if I read the tea leaves or I look at the hand that I've been dealt so far, you know, there are just too many unknowns, and there are too many things that really suggest very substantial risk. And one can, you know, go a long list of these. And so I think we are in dangerous waters. I do think we need some more fiscal centralization, but not necessarily quite the way Mrs. Merkel sees it, because I think she, you know, she's too conservative. Basically, is the problem.
Well, she also mistrusts markets. This is an old communist. She grew up in East Germany, for God's sake.
She's a physicist by training.
Yeah.
There is
you don't trust markets.
just
You spent some time.
Sarkozy's the same one.
coming back
He's
to
the
that,
latest.
coming back to that
Trust
comment, some of the best capitalists actually grew up in the communism. So you look at the Russian
Well, the richest
billionaires.
capitalists, yeah, some of the richest
exactly.
guys.
So like, you know, but because he you know, has nothing to do with it. It has more to do with the fact that, like, if you go to France or Germany, they don't even know what the stock market does. It's a difference in social aspects between North America and Europe, where Europe people kind of give their deposits to the banks or whatever. They have the annuities, they have the benefits, they have everything. They don't have to do defined contribution plans, and they have no culture whatsoever what the markets do. Markets are the evil in all of continental Europe by social differences to the Anglo-Saxon, UK, US model. So, you know, that bias about the transfer tax comes from that. Well, the German banking system is not going to feel it. Because that's capital markets is not how they do business in Germany, right? So, like, German business is not going to feel it because they don't do public offerings of these things. So the tax is only going to apply to London, which is why Cameron walked out of that meeting there at some point. Because, I mean, that tax is just like, you know, like a red herring in France and in Germany, and it basically hits London. Nothing else. Right? So that's why London is pushing against it, because, I mean, London is a financial center and Frankfurt is not, more or less. Paris is not. I mean, the Paris Stock Exchange, no one knows where it is. It's the same level that it was in the 90s. Period. They don't care. The society moves on, they smoke, they drink, they have fun. Right? So it's just a different core value system that they have. Doesn't mean that they don't like capitalism, they like exporting, for sure. And they don't like, they see that as a shock from the system coming from a Federal Reserve's policy, which was really stupid. I'm on the record since 2001 that Greenspan should probably be investigated, but and at that point people thought I was crazy at that point. But I mean, really the shock is, from their perspective, external, because without the printing in the U.S., you wouldn't have that problem in Europe. There's actually research what happens when you have a crisis like that, and inadvertently in 3 or 4 years after a liquidity crisis, there is a sovereign crisis. It's always happened throughout history that the fallout impact of a liquidity crisis is a sovereign default somewhere. And we had it in the 90s, we had it before, we had it under communism, we had it under capitalism. It's a given. It's just the nature of the beast. Like, you have a liquidity event, someone suffers down the road. And the liquidity event was more or less triggered in the US. They see it as an external risk to the euro, not as an internal problem that much. And that's probably why they slowed down the resolution, because they don't see it as an internal problem initially. They saw it as a market threat to the euro's stability and everything, and then the fiscal didn't really change. And to my point, Italy didn't have a better fiscal policy before the euro implementation, right? So it's not like all of a sudden they woke up and they said, well, Italy is just going to be like irresponsible from now on. No, they were irresponsible. They had communist governments, probably more communist than Russia did at some point. And then they had like consistently bad policy after World War II.
But they had the lira. Yeah, they don't.
Yeah, and the
And
lira
they had
could
inflation.
add zeros, Alena.
Yeah.
So basically, I don't see us, all of us here, necessarily disagreeing as much as some of you might think. Maybe I disagree with your comment that Greeks joined the Eurozone, therefore they were somehow innovatively were able to borrow at low rates. There was no discrimination in risk premium. But why is that inevitable? Why did the analysts forget about default risk? Why did they just, okay, currency risk was the same, but default risk, why did they forget about that? I don't see that
It was an
as-
assumption.
as-
That's the
exactly,
assumption
that's
in
just
the-
an assumption, but why?
Well,
not
ask
inevitable.
the gnomes in Basel. I mean, that, you know, you
It's
think about it,
two
you look at,
things.
yeah,
Yeah.
you look at the history of sovereign default. Greece has been in default half the time during its independence since 1825. It's been in default
So,
half the time.
why wasn't it
Spain
priced
has
in?
defaulted 18 times since 1495.
Two things happened. To his point, Basel. The other one as well, going back to my point, U.S. took the yield carry away from world markets. You take the yield carry away, you have credit carry. There is no other way you can generate returns. And you look at where's the next best yield that you can give like 5 basis points more, hoping that in a year's time they're not going to default kind of thing. And then, like, you know, at some point it's really hard to say no to your traders. We did, but it's all about credit carry that replaced the yield carry that was taken away from markets.
At Namura, we were doing this in July of 1998, for Christ's sake, before Russia melted down. We lost 3 yards in that whole debacle, $3 billion.
Well, the same situation is with Japan, for example. Right now, 200% of GDP public debt. Money keeps flowing in. Why? It just keeps the currency strong, which doesn't help exports, doesn't help growth. So why does the money keep flowing in?
But Japan has its own problems in terms of its age structure, its unwillingness to allow new blood in.
But I'm just-
And yeah, so.
Yeah. But if
it's
it
a
was
fairly
any other
unique-
country with such a debt level, right, they would have been already completely
toast,
cut
pretty
off
toast.
But one,
But
from
it's
financial
also-
markets.
Yeah, but it's also, most of the debt is held internally,
Yeah.
which also makes a big difference as to, you can't just look at the debt to GDP ratio, you also have to look at.
No, I was looking at a comment by the
Well, it's
finance
internally
minister.
held. I mean, it's Campo and Ucho there, you know, the two big pension funds, and the banks. But if New Zealand was in the position of Japan 20 years ago, they'd never have the problems that they had. Japan actually has it, but they're on a fuse as well, because they've got a fiscal time bomb, a demographic and fiscal time bomb that's going to prevent them from paying the interest, because the net interest that needs to be paid still has to be generated from some activity. Otherwise, you're in the U.S. scenario, and you just print up the money and hope you don't get a burst of inflation.
And that's really the other big thing that really would be an absolute kick in the head, is if you went, in fact, got the inflation scenario, because that would balloon the interest payments on all this debt.
Yeah.
And, you know, then,
Well,
it's.
That's why they've imposed this fiscal repression on the markets in order to get the rates down. They've created a completely artificial situation that goes back to my earlier point about constrained future policy choices. But I also want to make one other point in terms of how this crisis is being handled that goes back to what I was saying about leadership. The way this crisis is being handled in Europe is completely at odds with how sovereign debt crises were handled in the entire last 100 years. We have several hundred cases of restructurings. There were two basic restructuring mechanisms that were common to the post-war period. One was Paris Club. That's if you're a low-income country and you benefit from donor flows. Donor flows being World Bank, Asian Development Bank, Islamic Development Bank, flows that are funding your economy and providing development finance. You run into trouble. You're Jamaica in the 1980s. You run into trouble. You go to the Paris Club. They'll rewrite the debt. They won't take a haircut, but they'll extend, and they might give you a lower coupon. That was Paris Club. The other major debt restructuring framework that grew up in the post-war period was the so-called London Club, which is not really a club, it's bank advisory. So I'm the debtor, I sit across from you, you're the creditor, we're at a table, and we talk it out. That's how the Latin American debt crisis was resolved over a period of about 7 or 8 years in the 1980s, and how all non-Paris Club resolutions were achieved. If we look at what they were doing to Iceland, Ireland, Latvia, Greece, and all these big boys ganging up against these little countries, you had the the Troika, the EU, ECB, IMF. What's the IMF doing in a sovereign debt restructuring? It's a completely new role for these guys. On top of that, you have the Institute of International Finance, which is basically a bankers club, also getting into the mix. And there are these little, poor little countries getting beaten over the head, being told what to do by all these very large gorillas in a room, completely at odds. So what you're ending up with in all of these restructurings is an extremely creditor-friendly set of arrangements. Creditor-friendly meaning the banks are running the process to their own benefit. The process in Iceland, when we were advising Iceland, was identical to Greece. What we told the Icelanders is, don't take any of this money. Don't take the bailout. And they didn't. They took a little bit of money to refloat themselves, but they didn't take the bailout money. What happened in Greece with the bailout money, to your point about making things more costly, is that 85% of the bailout funds that were ostensibly on their way to Greece round trip to the banks, and the banks were pulling the dough out. So the bailout money comes in, and don't forget, that's not restructurable debt. That is super senior debt that is owed to one of these IFIs, like the ECB or the IMF, okay, or the EFSF. So you can't restructure that, it's unhaircuttable. So you trade stuff that you can haircut for stuff that you can't haircut, and you increase the debt load. Who pays? The man on the street. And so all these solutions have imposed a very creditor-friendly set of arrangements on these poor countries and turned the populations into debt slaves. And to my way of thinking, and to your point, I don't believe these arrangements are going to prove sustainable in the long term, or even in the medium term.
Sure.
There's going to be a big pushback.
And there's election years, and
yeah,
as I said, like, you know, Greece is going to have an election mandatory by next year. Italy is going to have an election, and all these people are going to be voting.
Yeah.
And that's the danger. And you see the far right everywhere in Europe, and you see, like, you know, there. If anyone's interested, can Google like what downtown Athens looks like today. Nothing like the time that Maria Callas used to live there, right? So it's already starting, and it's not pretty.
To Alena's earlier point, though, how do you mandate governments to think long-term against short-term mandates? And swapping one government for another isn't going to do it. It's not going to be until you get wholesale blood in the streets type of activity. I
Shooting
think
and looting.
Meaningful change.
Well, Samaras, the Greek guy, the New Democracy guy, has already said, looks like he's going to be the next prime minister in Greece. He's already said he's going to reopen the whole bailout. He's already, he's already on record, and it looks like the New Democracy is going to get power in Greece in the next election. And that comes back to my earlier point about the sustainability of these austerity programs across electoral cycles. Very difficult. So what these guys have done is they bet on a very long odds situation. Like Rob and I traded together. I mean, we wouldn't be sitting here today if we'd been making long odds bets all our lives. When you're a trader, you make a short odds bet that you're going to make money 70% out of 100, 70 times out of 100 on this thing. That's what you look for as a trader. You don't look for a situation where you got a 1 in 1,000 chance of making it big. That's sort of what's called the Brazil trade. You put on the big position, you go to the airport, buy a one-way ticket to Brazil, you phone the desk. If the position is in the money, you go back to work and collect your bonus. If you lose money, you get on the plane and you're gone. But there's no accountability with these people. They're making long odds bets, they're wrong, and there's no accountability.
Yes, well, I agree that this kind of political opportunism has been going on and is likely to go on, and what typically happens is that things have to get worse before they get better, when there comes that realization. But I think what Alex and I were saying, that, well, abandoning the euro, for example, would be a much worse case scenario, because we would see the absolute chaos, the high inflation, your assets being wiped away by the inflation, or which currency is it now denominated in, etc., etc. You look at Argentina, what happened there, they were reduced to a barter economy for a while. So obviously the cost of that would be much greater. And that's why we're saying that it would be unlikely if anybody is sane enough to recognize what that would mean to abandon the euro in a crisis situation like this.
Right. So to differentiate, sorry to interrupt, likelihood of someone defaulting is higher than the euro falling apart. And then the euro falling apart really doesn't work. It could happen, but think about it this way. So Greece gets out of the eurozone on their own volition, because that's the latest scenario, right? So, and then what happens? Like, they have, to your point, their debt is not internal, and it's denominated in euros, and just was done in a way that it's non-calculable.
Exactly.
So you own euros and you start printing drachmas, bringing your exchange rate in the opposite direction that you wanted, and it really increases the burden. And you cannot print away euros anymore. At this point, at least, they have the ability to kind of influence that. So in a worst-case scenario, they get out of the Euro Union and they start printing. It's not going to solve their problems, because their interest payments are still in euros. Their rate is going to deteriorate. They have to go to the open market and buy euros, and there's no way that their trade is not going to suffer. The consequences of leaving the eurozone might include penalties from the European Union and probably reduction of the transfers to Greece. And the only reason why Greece has a relatively stable standard of living was for these transfers, because otherwise you cannot sustain on a 40% spending on a 40% income kind of situation for a long time. So these subsidies from the European Union help that country pull itself out of where it was back in the 70s. So there are a lot more things on the table that are not necessarily tangible. But I kind of agree, like the worst case scenario for any of these countries is to leave the euro as a currency. Now, defaults, yeah, we had one. It's not an event. I mean, frankly, I did some fun search on Google Trends. I mean, no one cared about the euro before 2008 on Google, apparently. So, like, people didn't even know about it. And even if you look at it, like, the people who actually Googled that think it's Slovakia, Slovenia, and Latvia, and Estonia. Like, there is no interest whatsoever about the euro, even today, after all that media attention and everything. No one cares about it. Most of their trade is internal, with the exemption of Germany, maybe. And it really doesn't make any sense for them to abandon that thing, with the increase of borrowing cost is going to be even higher. And the interest rates are probably going to be prohibitively expensive for Greece anyway. And then the foreign currency is going to go in the opposite direction of their debt. It's really not pretty either. So it's not really a solution.
And all the political gain that you got from a European Union goes down the drain. So you had a high cost and you have nothing to end up showing for it. Now, I had prepared questions for several rounds, but this round was so fruitful that we don't really need them. And I always feel that the audience gets shortchanged and doesn't have the opportunity to really have a Q&A. So what I'd like to do is turn to Q&A, and if you guys don't have a lot to ask or to comment, then we'll go back to the panel. But I really like to have the group here have an opportunity. And so first in the back and then here. But you have to talk a little loud.
There are issues everywhere. How do you manage a globally diverse portfolio? Do you change your asset classes? Do you change your investments in different countries? Like, what do you consider a safe haven at this point?
If you can trust them.
It's not a buy and hold market.
Yeah, your point.
It's not a buy and hold market. Secondly, I would say that you're probably better off investing in corporate bonds than sovereign bonds. And thirdly, I would say that you got to be very careful with equities, because there are a lot of zombies out there. You don't want to invest in a zombie company, because they've allowed a lot of companies to continue in operation. And you can get a zombie two ways. One is a company can be legitimately insolvent and still trading. The other thing is you can have a company that's solvent, but only on the basis that all of its receivables are okay, and that its production contracts are okay. If its production contracts default, or it gets a big default on its receivables, you can have a solvent company turn insolvent. And there's a very high risk of that right now in both the North American and the European economies, because of In the United States, there's a statute called the Prompt Corrective Action Law, which mandates intervention when there's an impairment in a business or a bank. It's been ignored. And they've also struck down the mark-to-market accounting rules in April 2009, and were soon followed suit by the accounting bodies in Europe doing the same thing. So we've got less understanding of what's happening on bank and corporate balance sheets now because of these events, because the authorities have turned an intentional blind eye to the fact that a lot of restructuring needs to happen, and they've preferred to paper it over and kick the can down the road. That means for investors, due diligence of each opportunity is much, much more important and critical than it has ever been at any time in the past, and you can't rely on the rating agencies. Rating agencies are regularly gamed. I have a lot of experience with rating agencies as a sovereign borrower. We did a lot of work with the rating agencies because we were in trouble. We were getting downgraded in New Zealand. We had to get upgraded. We had to figure out how to do it. Let me tell you, these people get gamed all the time. And it's, they have a very difficult job because it's not easy to come by information. As an investor, you shouldn't rely on those credit ratings at all. Do your own work. That's
Doing your own work is costly.
That's right. Well, that information costs are high. But that's what Recovery Partners does. We do this with private limited companies that have no traded debt, no traded equity. So what do you price it at? That's what our job is. Call us. We'll do it for you. For a price.
So in light of the fiscal issues that have been highlighted here, in order to enhance fiscal responsibility, what do the panelists, I'm wondering, think about special drawing rights? Because there has been some talk nowadays about special drawing rights and how they may provide some sort of fiscal stability in that sense.
I'll say something. Special drawing rights to begin with. The name is entirely incorrect. I mean, it's a reserve asset created by the IMF, and there was a time where it thought that, well, it was a time when the major, by far, almost all the reserves were in U.S. dollars, and the U.S. Dollar confidence in the dollar had fallen considerably, and there was a move to try to increase, basically to replace the dollar as a reserve currency with SDRs. That fell through. First of all, the U.S. didn't want any part of it. It's easier to print your own money. Secondly, there were all sorts of difficulties with it. And what's happened over the period of time is that the special drawing rights, that reserve asset, has become a smaller and smaller percentage of reserves and become less important. And every once in a while it gets resurrected and there's an increase, but it doesn't amount to anything, and I don't think you can ever going to get agreement on making that as a major
To that
reserve.
point, it's just a basket of currencies that doesn't have circulation. Like, if you look at the euro, it actually replaced the economic currency unit, ECU, right? So it's not like Europe didn't have a common currency before. They had a basket of currency that was traded. You could borrow money in it, whatever. As far as circulation and adoption, it wasn't, because you couldn't buy anything on the street with it. So, SDR is going to face the same reality, which is basically Europe had a basket of currency and replaced it with an actual hard currency for a reason. Because the adoption rate is very, very hard for a basket that is not available to businesses and individuals. You cannot have savings in a basket. It's just between governments. I mean, how are people going and corporations going to deal with it? Because it's not available.
The only difference is that you would have then the backing of the IMF,
Yeah.
as opposed
but
to
I'll-
backing of the sovereign.
Yeah, I'll leave it further than that and say that we should abolish the IMF.
Well, I would disagree with that.
But
What purpose
but
does it
maybe
serve?
You need,
It's the big gorilla that beats up the little countries to make them pay the banks. That's all
Well-
it's been doing for the last 5 years.
well, I
That's
think
all it's been
that
doing.
its
15.
record actually in the last 5 years is better than it was in the 15 years before that. If
For
you
the last
look at
20 years,
the-
they've been people searching for a mission. They've been searching for something to do, and now they've found it in Europe. They're working on that. And I was there with the MCM people in October. I asked them, I said, why have you done this with Greece? They're now $130 billion more in debt. Everybody could see that this is unsustainable. Why are you pretending that this is a sustainable situation? They didn't have an answer. Because it goes back to what I'm saying. The internal politics makes them very difficult to resist what the banking interests are asking them to do. Banks, the big banks are run that place for their own benefit. And that's where it's gone way off the rails from what its original mandate was meant to be.
The euro's held up pretty well in terms of the value of the currency compared to the U.S. dollar and the Canadian dollar. It hasn't fallen as much as the U.S. did over the 2 years of its crisis. I guess going forward, assuming that things actually abate and they sort of do repair, what does that say about the valuation of the euro? Will it always trade at a discount, knowing that it in itself caused some, I guess, caused a delay in exiting out of the crisis and the inability of the ECB to sort of solve it? Does that bode better for the U.S. dollar valuation in terms of a reserve currency?
Well, it's a bit of a mug's game because it's a choice among. When you look at the situation in the U.S., and you look at the situation in Europe, and you look at the situation in Japan or in Asia, there's a reason why the U.S. hasn't quite lost its reserve currency status, but why other currencies are stepping up. It's essentially putting a basket of failures together as opposed to putting all your eggs in one. Whether you buy the euro or the U.S. is a bit of a mug's game right now. To me, it's not where the euro is going to trade over the next year to 2 years to 3 years. It's what's going on in the periphery, what's going on in emerging markets. Or currencies like Canada, Kiwi, Aussie going to react. And I think that's really where the play is, where you're going to see a much more aggressive flow of capital and investment, which will ultimately drive the value of the currency. So the U.S. dollar is in long-term secular decline. It's just a matter of against which currency pair. When you hold the U.S. dollar up against the euro, you could argue it's a bit of a push right now. The U.S. has got its own problems, and if you're looking at the euro-dollar exchange rate, it's a bit of an unholy alliance right now. Which one is going to weaken more than the other? When you start looking at the cross-currency pairs, whether it's Canada yen or some of the South American currencies against these pairs, that's where you're going to get a real sense of where the strength and weakness lies. So, to the comment or the question somebody was asking, where quote smart money is thinking the euro will go, well, sure, in the short run, if you papered over a band-aid solution, you're simply forestalling the inevitable adjustment. The euro could engage in a relief rally over the short term. In the long term, it'll weaken. It's just a function of will it weaken as a result of a black swan event, or will it weaken as a result of relative outperformance by other economies globally? It'll be one or the other.
Actually, one of those tricky questions here. Any exit out of the euro of a weaker peripheral country might actually strengthen it.
Yeah.
And that's how it plays out. Like, it's like I talked to a guy who has been doing this a long time, and he's like, well, the euro has an explicit risk of going up because things are good and going up because things are bad, extremely bad, and then if nothing really happens, it might actually slide. Because you have like the two extremes are pointing in the same direction, which it's kind of asymmetrical if you want, and then like status quo is kind of like who cares?
Unless things
So
change,
you've got a
they'll stay the
bifurcated
same.
distribution.
Right.
Yeah.
So
Bifurcated
basically, in
distribution.
the worst case scenario, in the best case scenario, it goes up, likely, and then in the middle, you don't really care that much. Could go down, could go up. I mean, it's a trend, and then it's like in the middle, it's kind of dictated by like the old FX theory, where it's like U.S. rates are 0.25, ours 1, like differentials and all that. Like they work around the middle, but if you go to the extremes, that all doesn't apply. Because again, like remember, it's political risk we're assessing here. And then like if say Germany and France and whatever form a core euro, these are strong economies with much better fundamentals, much better economies. So that basically is the reason why Germany exports so much, because they get this benefit from the diversification of the zones. And everyone gets the benefit because Germany actually buys from all these countries their inputs. So if you look at the German economy, that's like most of their inputs are actually sourced out within the euro system, and they export. So it's just like, it's your choice whether Italy exports or Germany. It doesn't really matter. focus on a system, and that's why I believe euro is going to stay there. It's like it doesn't really matter who exports. If you shift it to Greece, it's not going to create a problem to Germany. It's actually going to create a problem to Greece because Greek exports to Germany is going to slow, right? Because Germany is not going to export, they're not going to need these imports. It's just like, where do you want to have your exports in that system is going to be where capital and labor is most productive. And I don't see Greek or Italian companies being capital or labor productive. And that's the problem.
I mean, one of the problems is, how do you get an economy such as Greece to be a lot more competitive when you can't use the devaluation? Not necessarily that the devaluation would work, but it at least allows a possibility, and you're not allowed that here. The other thing that you have to keep in mind in case of the euro is that in terms of external exports, Germany gains by a lower euro and becomes a lot more competitive. So, it's not clear that they want to see a very high euro. Just like the Japanese now are really not very happy with the high yen. The other thing, though, that I want to say with what's causing problems here with all these weak sisters, of these weak economies, that money is flowing to the emerging economies, and in some of those, such as the Chinese case, the regime is able to keep the currency at a certain level, or let it not rise to the extent it otherwise would. Whereas in some others, that's not possible. So you create tension there too in the system.
You can see it in Switzerland, right in the middle of the Eurozone. You've got a crisis going on. A can of Coke costs $12.
Yeah, because the money flowing into Switzerland, pushing the currency up, causing all sorts of difficulties for Swiss exports.
But what's happening with the Swiss francs is actually an example why getting out of the euro system is not going to work for anyone, because you become such an easy target. Again, like in a global economy where capital flows are free, you become such an easy target. So say you go back to the drachma or whatever equivalent of that.
New drama.
New drama, more like it. Because I mean, if you don't change your fiscal policy, you're gonna get the sources of the world, whatever the new generation of that is, fence you and start attacking that currency to the point that what happened with the Swiss franc is the right example. British pound is the same example. If big company, big countries like Britain and the Swiss couldn't manage their currencies, I mean, Swiss economy is doing okay. Just came back. It's not true. It's not $12. It's probably $3. But the shot of espresso is 3 francs. I'm like, what are you guys smoking? And it's like you go to France, it's a euro 50, right? So okay, I want to live in France and have shots of espresso and cigarettes. That's fine. The problem there is, it's nothing wrong with the Swiss economy per se, and all of a sudden you have that inflow of capital triggering the valuation change in your Swiss franc, and all of a sudden they basically were forced to peg. And are they going to unpeg? Unlikely. Are they going to join the euro? I don't know. But I mean, basically, individual countries, unless they're China or India, and free floating currencies don't mix in the current world, and that's a sad thing, because printing doesn't work. It doesn't work for the US, it doesn't work for Europe, it doesn't work for any mature economy, it doesn't work for any emerging economy. The only reason why Argentina is semi-recovering is because of the commodity boom, right? So printing doesn't work. The tax cuts that the US attempted didn't work. The rational economic theory whereby all these little things that we thought worked back in like 1929, they might have worked because of World War II or whatever, and they don't work today. And that's the problem.
We could have another entire panel discussion about the value of the gold standard and bringing us back to a scenario where the allocation of investment in resources and trade-based activity will ultimately determine the value of a currency.
But as Bernanke said, there is not enough physical gold to bring it back. So.
Unless the price is $10,000 an ounce.
And it has too many flaws in itself. I'm only going to be able to allow one more question, unless there's one from this side, because there's a class coming in at 7, unfortunately.
I can speak up or.
Speak up.
Okay. Okay. So basically, my question is that the panel discussed that Greek is like in a building without an exit. So let's assume that they can't fix their debt obligation problems and they default. Is that going to cause major run at some of these banks in Europe, and is that contagion going to spread to across the pond?
They just defaulted. People didn't know this.
They defaulted.
They just defaulted. It was
Just
a job.
defaulted that.
They restructured, didn't they? Or
But it was only a $3.7 billion payout, so.
It was, and 3.7 was actually more than generous. The original is the treatment was 500 million or whatever, right? So they just defaulted. Restructuring is soft default. They just did that. Like no one noticed it. Yields improved. I'm like, you cannot come up with this thing. You cannot rationally justify it.
You couldn't make this stuff up.
But reality is same thing, right? So reality is a default doesn't matter. What matters is, are they gonna, after that default, implement policies or not? Because if they have to default another time and another time and another time, that opens a lot of different discussions. Right?
People will see that the emperor has no clothes.
Yeah, part of the reason the Greek thing was stretched out, part of the reason they went down this road, and what the IMF didn't answer when I confronted them with this, is the fact that the banks had to get their exposures down. Because you had a debt substitution. There was bank debt in there, and that was substituted with debt to the IFIs, to these flows. And that happened in Ireland. It was attempted in Iceland to some extent because there were a lot of trapped glacier bonds. And the whole idea behind the IMF bailout for those guys was to get the trapped glacier bond holders like Paribas and the ECB out whole. That didn't happen there, and they had to take haircuts. What will happen if Greece defaults this time is that the IFIs are going to have to see to their own solvency, because the ECB is in big time. The IMF's got some flows in there into Greece, and there'll have to be some kind of restructuring. And it's unlikely, in my view, that the IFIs are going to agree to a haircut on their debt. They never have historically. And this could lead to quite a lengthy workout process. We're in uncharted territory, which again, I'd say, black swans, we've got more possibility of black swans now.
Or worst case, right? To that vein, to that avenue, if your creditors are the ECB and the IMF, this gets escalated to higher political bodies or whatever. So there's going to be a push for a mechanism to enforce these countries to basically relinquish sovereignty.
Yeah, we're back to
over
dealing
fiscal
with
policy, right?
We're back to dealing with Germany in the 1920s. That whole process stretched out from 1918 through to World War II. It was never resolved. Schacht, who was the finance minister in Germany for most of the peace, and he was Hitler's first finance minister, was negotiating this thing for about 15 years. It was never resolved. The Germans ended up walking away and starting a war.
But the thing is that for various reasons, it seems that you can't really get a hold of the problem. I mean, it's the same, we mentioned Latin America before. To iron that out and to basically restructure that debt took years and years. The countries and the banks were unwilling to take the hit, so it got prolonged.
All the Canadian banks at that time, when Rob and I were working at BMO, were working in an insolvent institution. BMO was insolvent. They didn't take the hit. They couldn't. They're bankrupt, and this was kept secret. And so was the Royal, and so was TD, and so was CIBC. The entire Canadian banking system through the 80s and into the early 90s was bankrupt. It was completely insolvent.